All right, everybody, welcome back joining my podcast. This is the second episode of a multi-series podcast. We have recorded a podcast. If you haven't watched that, we discussed to the length in terms of what are the strategies we have, what are the options we have when it comes to retirement planning, kids education planning, and any financial planning for that matter. We discussed that to the detail. If you haven't watched that video, please go back and check. There will be a link up here as well that you can click on it. And today we're going to discuss a little bit more in detail in terms of what are the alternate options we have when it comes to RRSP, RESP, different strategies. So I have invited again my friend Kelvin. So Kelvin, please give us a quick intro and we will jump right into it.
Hey, Yasin, how's everything going?
Everything's perfect. It's a Sunday afternoon in Toronto and the weather is gorgeous.
That's awesome. That's awesome. Same thing here out in Vancouver. We're blessed to be able to have some great weather today. Raincouver, as they call it, right? So, being able to
Yeah.
soak up all the sun that we can is definitely enticing for sure. And do want to say, of course, thank you so much for being able to have me back on your podcast. This was definitely a great series that we're going to be able to record for our audience. And I definitely think we're going to be able to provide some great value.
Awesome. No, really appreciate your time as well. I think because this is very informational content. A lot of my colleagues and my circle, they don't really know about those different options. We only know about RSP, RSP, TFSA. That's pretty much it. I think that's where we also discussed in our previous episode as well. So today we're going to discuss more in details. Okay, what are the options? And tell us, like an average person, like if you're talking to every person, how would you educate that person in terms of, okay, what are the options? Should we stick with our default options or should we explore other options that we have in Canada? And given all the macro factors and interest rate and all those recessionary fears, how would you recommend we should be doing in terms of selecting those tools?
Definitely, for sure. And I think what referencing our previous video, we talked about RRSPs, RESPs. Today, we're going to be talking a little bit more about options and those strategies that we can really put into the picture. Right now, what I really like to do is I always like to build something called a home or a financial home. Right now, the thing about a home is, of course, the most important part of any house or any home for that matter is the foundation. And in our financial home for that matter, our ability to earn income is the foundation, right? So we always want to look and protecting that foundation, right? Now, the three things that can stop us, God forbid anything happens, is first going to be death, disability, or a critical illness that can potentially harm or cause that base, that foundation, to be affected. Right now, with death, it's hard for the family, and there's two types of stress that come with a passing in the family. First is going to be emotional stress. Second is going to be that financial stress. Now, emotional stress that can be dealt with time. Time can heal all the emotional stress. However, financial stress that can multiply and compound with time. So we want to make sure that's taken care of, and how we're going to be able to do that. Second thing is going to be disability. A lot of people, when they have a disability, you're only covered through work through WCB, which is going to be workers' comp. It might be something different in Ontario, but it's an underlying same concept.
Yeah.
Right? So
Yeah.
if something happens, the income is not protected, right? If you go to the gym, for example, and you happen to hurt your back, for example, right? That will not be protected because you're not covered through your working hours. So we want to make sure that the disability cover factor is also covered. The third thing is going to be critical illness.
Yeah, so let me just interject. I think this is a very key point. A lot of people get some sort of a insurance from their employer, like disability insurance, critical illness, life insurance. But you're saying that if you are injured outside of your work, that insurance may not cover you because that insurance is only covering you up until your workplace boundaries.
Exactly. And I think a lot of people have this preconceived notion that, okay, I'm covered. However, you're only covered throughout the working hours. So,
Yeah.
literally a minute after you clock out of work, for example, something happens, you are not protected throughout that time. And that's just
Hmm.
something that people really need to keep in mind, and always having that. And this is going to tie back into something very important later on. Now, the last thing that we also want to talk about is not only death, not only disability, but also critical illness. Critical illness is a very important thing that we also need to know about, right? See, the
Yeah.
thing is that we all know somebody that's had a critical illness, whether that be a heart attack, stroke, things like that. Now, the craziest thing is that we will survive that critical illness. That's the craziest thing. But what
Mm.
happens throughout that time? We also cut the income. we cut that income when we're critically ill, and we still need to get our bills paid. At the end of the day, the bank or any financial institution, any lender is not going to say, hey, we understand that you got critically ill. We still need to get our mortgage payment at the first of the month or whenever your mortgage payment is for that month, right?
Absolutely.
There is that coverage that we also, and understanding that we also need to have. And we still need to get our bills paid. Ironically, there's actually a doctor that created critical illness because people who are in the hospital critically ill are more stressed about their bills and their payments than they are actually about their health. Right? So this
Mm,
is something that we also need to keep in mind is
yeah.
how do we keep that underlying foundation built? And
Yeah.
foundation is going to be very important when I bring it up in this topic.
Yeah,
Now,
which is very true. Outside of Canada, for example, there are some countries where the healthcare is not state provided. Then either you have to have insurance or you pay from your own pocket. And God forbid, if you don't have insurance, then basically you're funding from your own pocket. And the first, worry that you will have in your mind is how to pay the bills, right? So God forbid something happens, and of course, I think this content will also be applicable to people outside Canada who have not done anything with regards to their critical illness protection or life insurance or any of that matter. I think that's very important to understand the implications that if you don't have any of that coverage, what would happen, God forbid, if you don't have the healthcare coverage.
that is correct. And funny enough, I actually heard a podcast the other day. I forgot what the lady's name was, but essentially she was a Wall Street trader. She was working on Wall Street, making good income. She also had coverage from her work. This was not only, luckily enough, she was also able to have coverage, outside of work hours as well. But she was actually based in the United States. Now, why is this very important? Is because if you're not familiar, the United States does not have universal health care. So what had happened to this lady is that she was making a sandwich and she was cutting some bread and apparently she had cut her finger. Now the thing was is that a piece of her finger actually came off her body. I know it's a little bit gruesome. I don't want anybody, the viewers, picturing that. I hope that doesn't happen
Mm.
to you. I pray that doesn't happen to you. But this unfortunately happened. Now the thing was, even though she had coverage, she still had to pay out of her pocket. It was about a $15,000 medical bill. I believe,
Oh wow.
yeah, so it was quite expensive, right? And this lady, she was about 25, 26 at the time, so she was fairly young. And out of her pocket, she still had to pay about $1,500.
Wow, that's a huge bill.
It's massive, and we want to look at it
And this is in addition to the insurance coverage, right?
on top of the insurance you
Oh
still have to
wow.
pay
Okay.
that extra $1,500. And this is very strange and very, not want to say strange, but it's very ironic that even though we have coverage, we may not have coverage, right? And that's where we need to really look at these certain factors and how that will tie into some of the strategies that we're going to be talking about later on today.
Yeah.
So there's about 5 different ways that we can save and grow our money in Canada. Now, the 5 different ways determine if you're going to pay taxes now, later, or never. And those, if you have the choice, the audience, would you want to pay taxes now, later, or never? And I'm assuming, and I'm just going to take the assumption here, I don't think anybody wants to pay taxes,
Of
right?
course.
And we're saying that because at the end of the day, these are the options that we always want to give to our clients, and this is always what I want to say to our audience and our clients as well. Is that out of these options, there's only 2 legal ways or ways that you can legally save the taxes on the growth of your money. So the 5 different ways are going to be something like a family home, you're a resident that you live in. The good thing about a resident is that yes, you do have the ability to, let's say for this example, you have the ability to have a shelter, a home, right? But the thing is that it doesn't really provide you an income.
Yeah.
Now, people do, if they have basement suites or if they have, other rooms that they can rent out. Yes, it can help you with the mortgage, but it is not a source of income for you, and that's what we always want to keep in mind as well.
Yeah.
Now, the second thing, and that quite important as well, is going to be talking about an RRSP. The RRSP is great; it's a great account. However, we always want to look at money grows if invested. Only if the money is invested, then you will have growth. You will have that compounding. Right now,
Correct.
the thing is that RSPs are 100% taxable when they come up. So they're if you and I always recommend this for talking about the state of RRSPs, is that we always want to look at what the taxable implication was. If we go back to our first video, and I recommend all the viewers to be able to watch that if you haven't done so yet, but we always want to look at kind of what your tax bracket would be in that time, right? So theoretically, you could have a lower income for that year because you are now retired. You could technically, take out that money in smaller amounts, similar to something like an annuity, where you put in a little bit of money and then you can take out those funds tax free later, or not tax free, but you can take those out in smaller drips, is what I like to call it. So
Yeah.
you keep them out in smaller drips. Now, the third way that a lot of people are going to be looking at in terms of how we can save or grow our money are going to be non-registered accounts. So this is going to be something like an investment account that you have that isn't registered. So if it's not an RSP, if it's not a TFSA, if it's not an FHSA for that matter as well, you are going to be looking at a non-registered account. So this also includes second properties. So a lot of our viewers, if you do have a second property, this is going to be actually considered a non-registered account, non-registered investment. Now the thing is that they're 50% taxable and 50% tax free. So theoretically, and it's actually changed now. So let's say I had a capital gain of about 500,000, that 50% of it would be tax free, 50% would be taxable, and it's actually
Yeah, it's changed now, right? So I think they have increased it to 66%.
6.6%. So
Yeah.
2/3 of your tax, anything over $250,000 in capital gains, is now considered in that bracket where it would actually be 66%. So that's
Correct.
always something to keep in mind as well, where these tax implications are going to be there. Now, TFSA, I think we all know about. It's a tax-free savings account. Money grows if invested, just like an RSP. However, you can put after-tax money in there. You can allow the growth, allow the compounding to happen, and you can take out those funds tax-free. Theoretically, what I recommend for everybody as well is to also look at something like Canadian investments. The reason why I say that, you can
Because of dividend.
dividend. Now, the
Yeah.
thing is, we all love dividends. Dividends are great. However, the
Hmm.
one thing is that withholding tax that you're going to have in the U.S. Yes, if you do have a fund or an investment in the United States, that's fine through a TFSA. However, we also want to look at the dividend amount and what that's actually going to be. That's very, very important. But along with that as well is that we can also look at some of these options. Right now, one option that not a lot of people actually know about, and this is something I kind of want to talk about in terms of also retirement planning, is going to be something called a UL or WL. Now, what a UL and WL is essentially it's a universal life or a whole life insurance plan. Now, not a lot of people know this, and not a lot of people have heard about it.
Mm.
So let's actually talk about it.
Yeah, I haven't heard about that either. I mean, I know that the life insurance, but I don't know the difference between UL and WL.
And that's exactly what I'll be able to touch base on today. So, UL, Universal Life, is a non taxable account and there's no limit. So a TFSA has a limit, an RSP, even for that matter, does have a limit.
Mhm.
There's no limit to how much you can put into this account. And it also gives you protection for that foundation that we talked about previously with the death, disability, and critical illness. It can give you support and protection for that foundation. Now, when I sit down with a lot of families, a lot of our clients, we always want to look at the pay taxes never option. Now, once I've done that, then I move to the TFSAs, non-registered RSPs, family homes from there on forward, right? So that's
Mm.
not a lot of people have heard about it. So let's actually talk about it, right? So theoretically, let's say we're putting our money in the bank, right? And we all probably know this: the bank isn't giving us a great return, right?
Yeah.
I actually did a comparison about this with a client, and what had happened was that the client was getting about 0.7%. Now, the client had put in, I believe, about $60,000. $60,000, that's correct, over a 20-year timeline. Now,
Mm.
in compounding interest, the client had earned a little bit over, I believe it was $7,700. Now, is $7,700 over a 20-year timeline? Is that a good deal?
It's nothing. It would have been wiped out by the inflation already.
Exactly. And even with that as well, when we look at inflation, even without the recession or anything, average inflation for the last 20, 30, it's been about 2 to 3% average,
Yeah.
right? So we
Yeah.
always want to look at that as well. Now, the thing is that if you're saving $200, $300 a month into something like a ULWL, what happens is that you're also changing the interest rate. And on average, depending on the company, I like to use the number 8% because 8% on the rule of 72, you're looking at every 9 years that money's doubling, so you can potentially
Mm.
quadruple your money from your initial amount, right?
And is there any limitation in terms of the withdrawal? Like, when can you withdraw that
And
money?
that's exactly what I want to talk about. So
Yeah.
something like a ULWL, it's great. However, it is actually an insurance plan, and not a lot of people
Mm.
know this, but insurance and TFSAs are one of the only two ways that you can actually legally save the growth on your money in Canada. And this is something that's really
Mm.
important that I actually want to talk about to our viewers as well, right? So,
Yeah, this is interesting because I myself did not know about this. Like, I have the life insurance for myself, but I don't think this is going into any UL or WL account.
so,
So I'll have to check that.
so
Yeah.
there's three different types of insurances that we deal with. Now, when most
Mm.
people hear the word insurance, even for myself, I'm in BC, so ICBC, Insurance Corporation of British Columbia. When we think about our automobiles,
Yeah.
we think of, okay, if something happens, I'm covered.
Mm.
Now, that is one part of insurance that we think of something called term insurance or a temporary insurance is what I like to call it. Now, term
Yeah.
insurance, you're paying for this time and you're covered throughout that time. So similar to like car insurance, if I continue to pay my plan, I would essentially have coverage. Right now, the
Yeah.
thing about term insurance, and this is actually a fact, is that only 2% of term insurances are actually paid out. So if you do have an insurance plan, let's say a life insurance, for example, I recommend all of our viewers to definitely take a look into that and see what the coverage amount is and why it's very beneficial.
Yeah.
Now, the thing is about term insurance is that it's very cheap. It's
So just to for the audience, you mentioned that the typical payout percentage is 2%.
2% of term insurance policies actually
Term
get paid
insurance,
out.
which does it mean that only 2% of the people get paid out in case of the emergency?
Well, what would
That
happen
emerg-
is something like a term insurance, you're only covered for that X amount of time.
Yeah.
So most people, and I hope everybody lives a long life, but let's say I'm 30 years old and I have a 30-year term coverage. I'm only covered until age 60.
Mm.
So what happens from there on forward with a term coverage is that you do not have coverage. And if you do want to renew your term, it becomes
Mm. That would be very expensive.
very
Yeah.
expensive. It becomes
Yeah.
quad. I've seen pentuple the amount.
And I think the other piece is, you can start paying for your insurance, but at some point your financial situation may change and you may not be able to afford those payments, contribution. And if that happens, and if somebody drops out of that insurance, then of course, he's not going to take benefit of that insurance anymore, right? Because his contribution has stopped, and he's actually leaving that policy, on the table.
And when we look at that, let's say I was 30 years old, for example, or if I was 40 years old and I bought a 20 or 30-year plan, most
Mm.
people end up outliving that plan anyway.
Yeah.
Especially with what we look at in today's day and age, where our healthcare system is always getting better. There's new medicines, technological advancements when it comes to our health. People are living longer lives, and if we want to have
Yeah.
that coverage later down the road, we also want to look at how that can actually benefit us. So, term
Mm.
insurance, I like to think of something that, okay, only time I personally recommend term insurance is if somebody had bought a house. Now, why do
Right.
I recommend that? Is because a lot of people are going to pay mortgage insurance anyway. Now, when you pay mortgage insurance, and for all the viewers, it's mandated by your financial institution that you buy a mortgage insurance plan if you're paying, I believe, less than 20% of your down payment.
Yeah.
So the thing is why would I recommend term insurance over something like a mortgage insurance? Well, we also want to look at the factor here. Term insurance can cover you just the same way mortgage insurance does. However, when we look at mortgage insurance, who is the beneficiary of that insurance? It's actually the bank or
Banks. Yeah.
the term insurance is us. That's we,
Yeah.
my family, if I have a spouse, whatever it is. So,
I'm going to share a very interesting story about this. So when I moved to Canada in 2016, and I was living in the UK before, and when I got my first property, and the mortgage broker actually sold me the mortgage insurance. Back then, of course, I did not know much about that, and he kind of sold me as a protection for myself, right? But in fact, it was a protection to the bank, right? It was the bank's money that was being insured, should something happen to me, during my lifetime. And over time, I realized this is kind of a going against my favor, because let's say if something happens to me 10 years after, my the insurance that I purchased from that mortgage broker is going to cover only the remaining balance of that mortgage, right? Not the entire worth of the property. And but you are paying your monthly premium based upon the initial balance that you started off with. And then I realized, okay, man, this is not really good for myself, right? Because at the end of the day, I'm going to be the loser. And then I canceled that, and then I purchased a life insurance from an external a financial institution that will cover my entire life if something happens to me. So there will be a fixed premium that my family will get, if something happens to me. So I think a lot of people, they don't know about this. They went with the mortgage insurance because the bank mortgage broker will sell them as a protection, but eventually it's not the protection for themselves, it's a protection for the
For the
bank.
bank. And
Yeah.
it's how I usually draw a graph when I'm with clients when I show this. But for example, let's say you are paying, just for numbers sake, let's say you're paying $200 a month. And you had also mentioned this, you've seen that that's only going to cover the balance amount. So
Yeah.
as the balance decreases, as you're paying your monthly mortgage, you're still going to have to pay $200 a month.
If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property. Right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later. Yeah.
And even if that mortgage left is $1,000, I'm still having to pay that. Or what
Exactly.
I could recommend somebody to do is get something that's cheaper, like a term insurance policy. And what I would do is I would then set up, let's say, $1 million home. I mean, homes in BC and Ontario are getting outrageous.
Average $1 million. Yeah.
So $1 million term insurance plan, and it would not only be huge, and generally it would be quite cheaper, but also as well as that you also have consistent $1 million of coverage. What I
Mm-hmm.
also do is I also put it for the timeline of your mortgage.
Yeah.
So if you have a 25-year mortgage, for example, we put a 25-year term insurance policy onto that. So at least you're covered, not only, God forbid, something happens to you, but also as well as that you do have the ability to pay that loan off and keep that property in your family. So that's going to be very, very important. Now, we've talked about term insurance. Now let's actually talk about UL and WL. These are very important accounts that I think a lot of our viewers should definitely take a look at.
Yeah.
So universal life and whole life, they're very similar. However, they're slightly different. There are a few differences in them. Now, universal life and whole life, it's not temporary or term insurance. This is actually permanent coverage, permanent protection. Right now, the thing about a UL and a WL, I like to give them pet names, UL, WL. I like to call it a wealth account. It's a great account. You can build a lot of wealth. You have the protection. You have the coverage. But along with that as well is that a UL versus a WL, there's actually two portions of it. So a universal life is a little bit more flexible. Now, what does that mean? A lot of the companies offer this is that, let's say I go, out of the country for, let's say, a few months. I can put my plan on a premium holiday. I'm able to get that. So there's a little bit more flexibility with that. As opposed to a whole life, it's a little bit more strict. It's a strict 20-year pay, so you'd be paying for 20 years. However, once that 20 years is done, you don't have to put a single penny into that account.
Mm.
So that's where that definitely comes into the picture as well. Right now, I've actually I recently actually did this today. A client of mine was saving about $300 a month into something like an RESP or RRSP. Sorry. After 20 years, we started looking at the timeline and growth. The client was getting about 3.5%, which isn't terrible, but it's right around inflation. So
It's not good either. Yeah.
it's not really beating much, right? So after 20 years, when we did the comparison, this client had put about, I believe it was 60K. I think it was 250. So the client would have put in about 60K, right? Now, the thing is, over that 20 years, that money had doubled. And this is
Mhm.
just based on the even the numbers that we have. These are not realistic numbers. Of course, this is what we had shown the client. Our philosophy is always, you know, shoot low and aim high, right? And the thing is that we always want to undershow and over deliver. So we had put this at 8%. Is that 8% actually what the client's getting? No, it's probably double, if not triple that. So we want to look at that as well. Now, after 20 years in something like a ULWL, you don't put any money in and the account continues to grow. Why is that? Is because of compound interest.
Mm.
Now, a lot of people don't understand how UL and WL actually differ and what there is. So essentially what it is that you have an insurance portion and you also have an investment portion.
Right.
So let's say you're putting, for example, say $250 a month into this plan. A portion of that would be going towards just covering your insurance needs. The rest would be actually invested. And
Is it
that's
similar to segregated funds or is it different?
so segregated funds would be more of an investment account. This is going to be an insurance policy. And this
Okay.
is the thing is that not a lot of people actually know about this. And this is a
Mm.
very great tool to leverage to be able to have the understanding of it, right? Now, a lot of people, I think a lot of our viewers understand what compound interest is.
Yeah.
So we can definitely talk about that as well, right? So God forbid something would happen. Not only do I have a death benefit coverage of, let's say, 500,000 or $1 million for that matter, but I also have an investment account within this ULWL. So
Mm.
essentially, another difference between UL and WL is UL is based on the market. WL or whole life is going to be not only the market as well, but it also goes on dividends. So you do
Okay.
get a dividend amount that can be then deposited into your investment amount, and that will continue to compound over time.
So that's option is only available in WL, not in UL.
Oh, yeah. And now the
Okay.
thing is, whole life is a little bit more strict. I usually tend to go with a universal life to begin,
Mm.
unless I need to see the client's needs, their situations, and then I would go towards something like a whole life. Whole life is a bit more strict, and I always tell people that, and I always want to know about that as well.
Okay. Let me just rephrase. So the main difference between the UL and WL is the WL will allow you to reinvest the dividend payments that you're getting into it, versus the UL you cannot do that, right?
Yeah, so
So.
UL would be strictly based on it's how the investment is actually ran.
Mm.
So UL would be mostly through the market. Personally haven't seen anything else that's not beside the market. Obviously, you put it in, you can pick your funds, you can do all of that with your insurance company. Whole
Mm.
life is going to be something through dividends. So when you're working through dividends, for that matter, you have a little bit of understanding. Okay, if the company profits, I've seen some pretty good dividend rates that are out there, and it gives a
Mm.
little bit more security.
Okay, so that means the company who is going to manage UL versus WL, they will also selectively put that fund into those assets, right? So
And
let's say the UL fund will go into the assets which is not producing dividend, but they are perhaps the growth stock,
yeah,
versus the WL, which the fund is going to invest it into the asset classes which are going to pay cash flow like dividend, and that
definitely.
cash flow will be reinvested, right?
You
Okay.
can definitely reinvest that. Now, the one thing as well, and this is where I come in as a financial broker, I can always connect our clients with the company. And along with
Mm.
that, as well as I speak to a lot of investment managers, a lot of insurance managers within these companies to see what funds are performing well and consistent well over 20, 30, 50 year timeline as well, right?
Right.
So that's where I come in as a financial broker, where I'm able to understand, okay, this is what's going on, this is what the client has, and this is what they're looking to purchase or looking to be able to put their money into to
Mm.
grow that money. And then I will also be able to leverage our investment managers, fund managers at these companies to make sure that whatever funds are going to be allocated, they're allocated not only in the correct manner, but also in a growth factor as well.
Okay.
Whereas like a whole life, you're going to be looking at mostly dividends. So this is going to be within the company.
Okay.
Now, there is a little bit of flexibility in universal life. That's why I usually like to go with the universal life first option. Um, Personally, whole lives, there's a situation where somebody will need a whole life, right? And this is where we also come in. So this is actually, not a lot of people know this, but there's actually two ways that you can save and grow the money tax free in Canada is going to be TFSA and insurances, an insurance policy for that matter. Now, people don't know a lot about insurances. So this insurance is going to be a half investment, half insurance. I would say it's
Mm.
probably a third insurance and two-thirds investments. Depending on the company, of course, that you work with. I work with a lot of
Yeah.
companies, so I'm able to see what they're able to provide.
So just a question. So their premium, is it a little bit expensive than a typical insurance, which doesn't have any investment part attached to it?
Yeah. So that would be something like a term insurance. Now the thing is,
Okay.
term insurance tend to be a little bit cheaper because you're only covered for
For the
insurance.
insurance, there is
Yeah,
no investment. Yeah.
there's
Okay.
no investment portion. So these
Mm.
plans tend to be a little bit more expensive. However, you're also growing your money and it's permanent. You have coverage until age 100.
Okay. Got it.
That's where that comes into the picture as well. Now,
Okay.
people don't know there are different types of insurances. So this is insurance, of course, is going to be a half, or I'd say two-thirds investment, one-third insurance. Now, the thing is about this plan is that if you take the insurance out of this plan,
Hmm.
it's now an investment and that can get taxed. It would be considered something like a non-registered account.
Okay.
Now, can you touch the money usually within these plans? Yes, you can. However, it's usually not for the first 3 years. Now, why is that? Is because the company has more liability covering you for X amount of insurance
Mm.
than you putting in $200 a month into this plan.
Right.
That's just the harsh reality of it, right?
And if they touch the investment like before the time when they need that, would that also make any changes on the insurance?
Yeah. So what could happen is that you're in these accounts. There's something
Mm.
called a cash value, and this is one of the most. This is one of the greatest accounts I think that ever existed. If you guys haven't looked at, so look at the Rockefeller method.
Mm.
They've been able to actually beat out a lot of competitors when they were coming up, especially in the oil stages in the early 1900s, because of universal, or I believe it was a whole life plan, but they were able to beat out hedge inflation, be able to go out there, have coverage, have that generational wealth, and
Mm.
also be able to use that money in their lifetimes as well.
Right.
Now, when we go back to it, there's actually two ways you can take out the money, and I'll explain to you both ways. Now, you can first surrender the account or take out the cash value.
Okay.
I don't recommend that because this account provides five very important things. First, it's an asset. Why do people like buying houses? Because it's an asset, it continues to grow over time, just as this account does as well.
Mm.
You lose the interest or a portion of the interest for that matter because you won't be able to access all the funds. There might be a surrender charge.
And
Third
then
thing,
you lose the insurance part of it as well,
you
right?
lose the insurance part of it as well
Yeah.
because now you aren't able to have insurance. You don't have a plan anymore. You actually lose also something called your retirement as well. Now, why is that? Did I say retirement? Why does this tie back into something like an RSP? Is because you can put money into this plan, have not only coverage, but you also have growth on the money,
Hmm.
and you're able to use that money. Now, a lot of people don't understand how we can actually use this money. Now, have you ever, I believe everybody's heard the term wealthy people don't use their own money, they use other people's money to be able to buy assets and
Yeah.
purchase, be able to
They
grow that.
use bank's money. Yeah.
Exactly. So same thing here. You actually
Mm.
do something called a collateral loan within this account or a line of credit. I
Mm.
think everybody knows what a line of credit is. Essentially, what happens, a collateral loan can only be used from something like an asset, which is like a house, for example, right? Now, the thing is that with this collateral loan, what happens, and I think me and you, Yassine, actually talked about this when we first met, was a lot of people don't understand how the collateral loan strategy works. So if I go to the bank and I say, hey, I have $1 million life insurance policy with $200,000 in cash value in there, I want to be able to leverage that money and I want to get the $200,000 out without actually canceling or surrendering the plan. Now, the great thing about this is that you can take that money out, use the money, go potentially, I would recommend buy assets, but you can
Mm.
also do that as well.
So basically, you can use your insurance asset as a collateral, and then you take a loan against that, right? Basically, there will be a lien on that asset from the bank,
Yeah.
and then you take a new loan out, and then you can basically use the money elsewhere.
Yeah. Now, what if I had to tell you that you didn't have to pay the money back?
Oh, really? Wow, that's interesting.
Now, why is that? Is because whatever you take out, the rest would be covered from the death benefit or the amount that's actually going inside the collateral loan, and the rest would go back to your family.
Okay,
This is where people run.
so this is, and I think you can explain to this sort of, but I had this question in my mind. So basically, if you take that loan out and you don't want to pay, and then something happens, God forbid, then whatever the payout from that insurance will actually cover that creditor as well, right? Actually,
That's
they will cover the creditor first, and then
and
whatever
then
is
you
left.
get the
Yeah.
difference.
Okay.
Now the thing is people are saying, and this is probably a question in the comments, that okay, why am I taking a loan out? Well, we also have to understand what the growth amount in this account is going to be far greater than what the loan amount that you're actually getting from the bank.
Hmm.
So what does that mean? The interest that you're getting from the bank is probably 3 to 5% average.
Yeah.
If your growth is 12 or 15%, you're still netting 8 to 10%.
Yeah. Your spread is 8%. Yeah.
So you're still getting that spread. And the thing about the spread is that that will continue to grow over time, and you still have money growing while also
Hmm.
using that money.
So basically, you're you're sharing a model which banks actually use it. So
Yeah,
banks business is all about spread, right? And they make money on the spread. So they lend you, they basically lend you the long term, and then they borrow short. I think this is how they do it, and then they actually make money on the spread. So you as a consumer will get less interest versus what they get from the asset side
yeah.
is more interest. So
And
yeah,
that's actually a big key factor of fractional reserve banking is that
yeah,
a lot of the money that when we put money, when we get money, what do? We put it in the bank. What happens with the bank? They actually either loan out your
they
money,
earn it out. Yeah.
right? So a lot of the loans are actually to investment companies. What they
Mm,
do is they take the interest, or of course the investment companies are going to take their cut. The banks are going to take their cut, and then they'll give you the spread, the difference, which is usually
yeah.
that 5 to 1% that we'll see at the bank, right? So that's where that comes into the picture as well. So
Interesting.
by leveraging a UL or even a whole life for that matter, you can also use this as a retirement. Why? Because you're putting money in. Later on in your years, you can have cash value built up in this account, and it's
Mm,
actually tax free. If you haven't read this book, Rich Dad Poor Dad, I recommend everybody to take a look at it. Is
yeah.
that rich people buy assets, right? Wealthy people buy the assets, and what do they do? I believe his name is Robert Kiyosaki.
Yeah.
People say, "Oh, he's near $1 billion in debt," but the thing is, debt isn't taxed. You can't tax debt.
Yeah.
So the thing is that even though he does have debt, he's using that to buy more assets, accumulating collateral loaning strategies, and those
Mm,
types of things. So that's where it definitely comes into as well.
yeah.
Now, you're leveraging this account not only for retirement, so you can grow your money as well. Obviously, you're hedging inflation, beating inflation, having a pretty good growth amount depending on the funds that you choose with your financial advisor and, of course, the investment company. You're building an asset. This asset continues to grow over time. You have retirement plan, and this is very important because now later on in your years, you've put in the money. Let's say over 20 years. Let's say you put in $60,000. That money will continue to grow. You can leverage the money, not have to pay
Mm,
taxes on that money, and along with that as well as you can even take out smaller collateral loans. Let's say every year.
right.
That's where the thing is coming into the picture as well. Is that you can also have this protection for yourself, that foundation that we were talking about earlier as well, to be able to make sure that you're completely covered.
Hmm.
And this is one of those UL, Universal Life or Whole Life, is a great account. And this is what I recommend a lot of people to also take a look into, is because an insurance is one of those only few ways that you're going to be able to do that.
Yeah.
So
Okay.
definitely recommending something like an insurance plan. And if you do have an insurance plan, I highly recommend talking to the institution that you had got that insurance plan from. See if it's a term account or a permanent account, and see what is going on and what the growth is. I highly recommend everybody to take a look at that.
Right. Now, this is a good pointer for me as well because, as I mentioned, I have the insurance, but I just bought it and then forget about it, right? So now you're telling me this, so I'll go back and then inquire more about whether this is UL versus WL, and how much of that asset has grown so far.
Exactly. And I think everybody should be able to take a look at that, because if we're going to be putting our money into something, not only do we want to have coverage, but we also want to look at, is this money actually going to be able to be beneficial for me,
Yeah,
right? And that's what we also want to look at over time as well, right?
absolutely.
So the second thing as well is that, in this account, there's how the money grows is something called an accumulation fund. So the money gets accumulated, it's saved up in the account. There's also a surrender value, how much you can take out. There is going to be a little bit of a fee. Always, most of the times, you want to keep that in mind. If you just cash out the account, right
Yeah.
now, if you cash out the account, of course, it's now taxable because now it's considered a non-registered investment. Why is that? Is because there's no insurance portion involved in that account.
Mm.
So that's where we want to, when we look at later years in retirement, we want to make sure that we can take out, smaller collateral loans throughout that time and save into an account like this. And this is something myself at Aegon Asset Management Transamerica can always help you out with that and be able to provide you that plan and strategy to be able to make sure that we can provide those values,
Yeah,
right?
absolutely. Absolutely.
Now, we usually, and I had mentioned this earlier, we always put our accounts on usually 8%. Now, will you be getting 8%? That's what the software allows us. For most companies, our software allows us to go up to 8%. Now, does that mean you're going to be getting 8%? No, you can potentially even get higher just based on even the S&P, which is averaging 10. So you always want to
Interesting.
keep that in mind, right? So you're covered from day one. You have the protection. You have a cash value built up in this account.
Mm.
And thing is that now you can use this account. This is a longer term account. We always want to recommend that, and we always want to let people know about that.
Yeah.
That Universal Life is a long term account. It's a 20-year account. After 20 years, you don't put a dime in there.
Yeah.
And that's where it comes into the picture. It comes in to save you later on, where you can take out those drips of collateral loans, have that protection as well. And along with this universal life and even whole life for that matter, you can also have riders. So a thing like a critical illness or a disability rider that can
Mm.
also be supplemented to cover that complete foundation and also
Yeah.
set you up for retirement later.
Okay. Interesting. And for folks, who's watching, please reach out to us. There is an email address in the description below if you need more help with regards to planning your retirement. Email it to us, and then I will connect with you with Kelvin and his team, and they can basically sit down with you, analyze your situation, and then we'll recommend you the best strategy for your retirement as well. So sorry for the interruption, guys. Just wanted to let you know that we have a team of realtors which is covering the entire GTA as well as some outside areas as well, like Brent region where I am based off, and I help out the clients in this region as well. So if you have any needs with regards to real estate transactions, buying, selling, investing, renting, let me know. There is a link down there where you can book a one-to-one consulting call with me, and we will be more than happy to help you out. Let's get back to the video.
And I think this is a great leeway and a great segue into something like an RESP. Now, quickly just to touch base on RSPs, I don't recommend everybody putting in all their money. It's a great account. Now, probably
Yeah.
people are thinking, oh, it's a great account. Um, I think we said this on the last podcast as well, is we don't want to keep all our eggs in one basket. If that basket happens to break, guess what happens? We don't have any eggs.
Exactly.
So what we do here in finance is very known. You're probably familiar with this as well. You've seen we use a 5-5-5 strategy. So 5% medium term or short term, medium term, and long term. So you want to save at least 15% of your monthly income into these assets that we can then
Mm.
grow over time, right? Now, the numbers that I've talked about, they're obviously random. It depends on your situation, age. There are a few factors that we want to keep in mind as well, right? So this is always going to be individualized for the client. Right now, when we're leewaying into something like an RESP, same thing. We all don't want to put all our eggs in one basket, and we always want to recommend both those options. Just like an RSP, we would recommend not only an RSP but also something like a universal life or a whole life. We also want to do that same thing with RESPs.
Mm.
Now, with an RESP, this is going to be a very similar plan as well. However, with RESPs, we would leverage something called a whole life plan. Now, why do we use a whole life as opposed to universal life? Now, in Canada, I believe this is a rule worldwide for that matter. If you have a universal life insurance policy, you have to be older, 16 years of age or older. A whole life plan, you can get that from the day, I believe it's 15 days old to your child. So literally the child could be born and you have something like a whole life that you can set up for them and always have this plan set up.
Okay.
Now, I like to use, and this is one great way to put it. I like to call this plan a $1 million baby plan. Now, why do I like using the word $1 million baby plan? Because not only do you put in that money for, let's say, 10, 20, it's about 20 years, it's 20-year fixed pay. But the thing about that as well is that over time, now you have those funds that you can then, similarly like a UL, you can then take out those funds over time. So let's say your child is 5 years old. The account would be done at the age of 25. Now, when the
From a contribution perspective, right?
Yeah. So after your contribution at the age of 25, what could happen is, as a parent, you always put your child into something like that as well, and you can get them to pay it, right?
Mm.
I think children that are, or not children, but young adults that are going to be working, um, make sure they have the ability to save into this account after 25. You don't have to do anything. There will
Yeah.
be a cash value built up in this account. And then later on in the years, you'll let that compounding grow. And
Mm.
at the age of 65, based on the calculations that I've done quite a bit, the child would have over $1 million easily into something like this as well. So
Interesting.
what I recommend for a lot of parents to do is, not only we talked about RESPs and the grants and what you're able to get from the government as well, but also look at something like a whole life plan or a children's whole life plan that would be able to provide you those strategies
Mm.
as well. So that's where it really comes into the picture as well, is that understanding how insurance as an asset class can actually be one of the best investments that you can make. When people think of insurance, they only think of
Yeah.
coverage. But
Exactly.
when we think of insurance from the whole life and universal life perspective, it can be one of the greatest asset classes. There's always that
Mm.
protection there. Later on, I know in the United States as well, they use something called an IUL, which is an indexed universal life. You're able to get annuities out of that. Take out those annuities tax
Mm.
free, and leveraging that account, still having the protection, still having that coverage. And that's definitely one of the greatest things I've definitely seen in my career so far, is understanding that we're able to have these options not only for our clients as well, but we also want to look at what we can do and how we're able to do it, right? And
Yeah.
if we can have something like $1 million baby plan set up for a child, now what happens is that we now know that this child is set up. A lot of questions I also get is, okay, why does a child need coverage? Well, if we take, as we mentioned, if we take the child or the insurance portion out for the child doesn't need insurance, but that's what makes it tax free, and that's what allows it to be that type of
So this is very important point that you mentioned. So you're saying that one of the one of the advantages having insurance attached to the investment is providing you the tax shelter,
yeah,
right? So in a case of child, when the child is just born, he or she doesn't need insurance, but because the insurance piece is attached with the investment, this is providing you a tax shelter to begin with,
yeah, and that's
right?
where not a lot of people are actually aware of
Mm.
having something like an account like a whole life can definitely be one of the greatest asset classes, not only for a child.
Wow, yeah, I did not think about this, so this is something new for me as well.
Yeah,
So there are more than one tax shelter. So a lot of people that I talk to, they only know about one single tax shelter, which is your primary residence, right?
yeah,
But there are more than that available. I think we just need to explore and then sit something like somebody like yourself, to kind of understanding the overall strategy and the options to kind of select and basically pick yourself, which one is going to be better for you and your family. And yeah, there are more strategies to save taxes
yes.
versus
And the
just on
thing,
real estate.
the beauty about something like a whole life account is that it doesn't, like an RESP can only be used for school, right? A
Mm,
whole life can be used for anything. This can be used for school. It can be used for traveling. It can be used for your car, wedding.
yeah,
You have a
it's, it's
baby
it's an open kind of an account, right?
account.
And I think so, one can have both RESP and this whole life or whole life insurance plan attached with the insurance, right? So you can have both in parallel. You can be contributing into both at the same time. RESP will only fund your kids' education, but then the other one is going to fund pretty much everything outside education.
Everything else. And this is where we also want to be able to educate our audience as well, as to understand these options, understanding what's going on, how we're able to actually do that, have those options available.
Yeah.
And potentially later down the road, some children may not want to have a postgraduate education, or They
Mm.
may not want to be able to do that, and that's totally fine. It's up to them, right?
Yeah.
However, what we want to be able to have is that income that they can use later down the road, and along with that as well, it covers you for all phases of your life.
Yeah.
What I highly recommend is always doing a half and half, or maybe up to a 2/3 amount. So a
Mm.
third of RESP. Why do I recommend still an RESP? Is because you still get those government grants. You still get those contributions that you're going to be able to get. So you might as
Yeah.
well be able to take advantage of that. And then also the rest of it is going to be from something like a whole life. Now, one
Mm.
thing I wanted to note as well is that this is something that you're not going to have to pay out of pocket for. Why do I mention that? Because of that child tax benefit. If we can allocate that child tax benefit, or Canada Child Benefit, I believe is what it's called now, into
Mm.
the right manner, you're not taking money out of your paycheck. What you got to do is now you
Right.
have this government check that you're going to be getting in every month from
Yeah.
the government. You can just allocate those funds in a better manner to be able to make sure that not only is your child protected, they're covered for all stages of life, they have an asset that they're building, and this
Yeah.
can cover you potentially up to 3 generations as well. Why is that? Is because they're going to have kids. If they have it at the age of 2, for example, they're going to stop paying at age 22. They're going to have kids maybe in the 30s, 40s, 50s. Their children are going to have children as well. And what
Mm.
happens is that now you can have protection not only for your children, but along with that as well, is now you have protection and a little bit of asset class that you're going to be able to build for that following generation as
Mm. Interesting. And I think I think you already answered part of my questions. If somebody just want to have a whole life for kids, kids life planning, for example, can they do that without having that option for RESP, or
well.
RESP is a prerequisite?
So for compliance reasons, I always recommend both. So what I recommend for a lot of people, I've seen up to 90-10 split, so 90% whole life, 10% RESP. For
Mm.
compliance reasons, I always have to show both options. Now, why do I
Yeah.
show those both options? Is going to be because of those grants. You still have,
Mm.
government
Yeah.
grants.
You're leaving the money on the table if you're not picking up RESP. Yeah.
Exactly. And there's money on the table that, especially when it comes to children education, where
Mm.
um, postgraduate or even university level education is not getting any cheaper. And if we can be able to hedge against not only the inflation side about that, but also
Yeah.
getting these extra grants from the government to be able to then reinvest, be able to put into these accounts, we can definitely see that over a long period of time that whoever's in the market longer tends to win. That's where something like a whole life can help you out. Something like an RESP, I usually do both. Similar
Mm.
to an RSP, I always do an RSP or a universal life slash whole life. You have both those options. You have the coverage. Everything is good to go, and you can have that protection as well for
Okay.
RSP, and then also be able to, similar to both accounts that you own, you can leverage that asset and be able to go out there and really provide that value, and be able to get those funds not only growing, but along with that as well is you're going to be able to have a all-in-one account is the best way
Mm.
to put it.
Yeah. No, this is good. This is great information, Calvin. So thanks for that. And folks, if you've been watching, so please click on the description, expand it, and there is an email address. Reach out to us if you want to have more information, or maybe a one-to-one consulting call with Calvin. So reach out to us, and we'll be happy to help you. And start your journey now, because a lot of people they always think about it and delay, but I think the earlier you start, the better it's going to be for you and for your kids. So start your journey now. Start, email us with your information, reach out to us, we'll schedule a call, and we will be more than happy to help you on that journey as well. So Calvin, any last comment before we wrap up?
I definitely think this has been a great series so far. You've seen, I definitely think our viewers are going to be able to find a lot of knowledge and a lot of these options very valuable for them. And this is where
Absolutely.
we come in as Transamerica and Aegon Asset Management as advisors, and my team of advisors to be able to go out there, really provide that value, help out a lot of our viewers, and potentially be able to get this set up for them in the right manner, in the right way, and be able to get that going. So I definitely want to say, of course, thank you so much, Yassine, for being able to have me on another session, and we'll definitely be able to reconnect very, very soon.
Absolutely. Appreciate your time here, Calvin. So, folks, please subscribe to the channel if you haven't done so far. So, we will be continue putting a lot of content like this one on weekly basis. So, please stay tuned, and we'll see you in our next video. Thank you.
Thank you.